Welcome to the Personal Pension Radio Podcast, where it's all about helping you complete your financial journey to retirement. Discover time-tested strategies and get unconventional insights into wealth building and retirement that actually work. Break away from the herd and go for the retirement you dream of. And now, here's your host, the income engineer, Kraig Strom.
All right, back on Personal Pension Radio. Thank you so much for being here. I really appreciate all the feedback. Love having the questions. Don't forget to keep those questions coming in. Email Kraig at kraigstrom.com. Remember, it's Kraig with a K. I am the income engineer broadcasting from the Personal Pension Radio Workshop here in Southern California. My goal, my mission, my hope, my dream is to help you with that retirement dream of yours. Make sure that it actually comes true. Make sure that you actually have a lifestyle to look forward to, and to help you pull back that curtain on the mainstream financial advice that so many of you that listen to this show have lately, and maybe not so lately, been saying, wait a minute, is this right? Is this the correct way to get ready for retirement? And there's been a lot of doubt lately, especially as the baby boomer generation has just been flooding into that retirement age, and it hasn't been working out nearly as well as they had been promised. So my mission, my goal is to really help people look forward to a retirement lifestyle that they can actually enjoy. That's the real goal. And the hard part is that most advisors, including myself, years and years and years ago, most financial advisors were educated by that same machine, that Wall Street funded education machine that teaches financial advisors how to teach you, the general public, how to save and invest and prepare for retirement. Unfortunately, the CPA world, the attorney world, the banker world, the insurance world, they all ultimately get information and education from the group of people that Wall Street has educated. And you have to remember, they educate us, financial advisors, with the information that benefits Wall Street, right? So what I have found over the years, and thankfully long ago, I found that the education I received was incomplete. It did not answer, how do I get maximum retirement income for my clients? How do I get maximum retirement income? And here's the thing, it wasn't an investment. Investments weren't the solution. And the truth is, the secret, if you will, to maximum retirement income is not an investment. It's not a product. It's not a, diversify into more real estate. It's not dollar cost averaging. The solution actually is a blend of a variety of different things that cross over from the investment world to the guaranteed world. Things like insurances, annuities, combined with investments, combined with how you use your real estate if you have rental properties and your business assets. It is truly a strategy that needs to be engineered. Hence, the income engineer was born out of my passion and desire to bring all of that together for that maximum income target. That's the goal. This show is meant to give you hope for retirement. If you're out there looking at your retirement and you have had a conversation with a financial advisor about how much income you can look forward to in retirement, and you're disappointed, you're thinking, I'm going to have to work until I'm 900 years old, I'm here to tell you, give me a call. Send me an email. Let's take a look at your situation, because with an actual engineered, designed retirement strategy, you might be able to turn that retirement light back on and have some hope to get out with a lifestyle you could enjoy. You just have to be willing to stop following that conventional Wall Street advice, that mainstream advice. If you hear it from everybody, that's the kind of advice I'm talking about. You hear financial entertainers on the radio talking, saying the solution is to maximize your 401k and to diversify your investments into 4 different buckets and da-da-da-da-da. No, it is not. That is not the solution. You cannot invest your way into maximum retirement income. It just doesn't work. The economics and the principles and rules prevent it from working. You've got to have an integrated approach that brings together all the different pieces of a retirement plan. And without that, you end up being relegated to the Wall Street investment-only retirement option. You just got to be willing to break away from that herd. Now, disclosure alert. I am not an attorney. I am not a certified public accountant. I am a certified financial planner professional. But please, whether I sound qualified or not, please don't act on things that you hear on this show as if you're hearing advice for you yourself personally. And especially, please do not act on things that you hear from financial entertainers like Dave Ramsey, who has no licensing, no business giving out financial advice, and he's not regulated, not monitored. Nobody keeps an eye on what he's saying. And you need to meet with a personal financial planner before engaging in making big financial decisions. So please do that. If you'd like to actually meet with me, I work with clients all over the United States. Thanks to technology, the world is a very small place that I have go-to meetings and webinars and such with folks all over the place. So you're welcome to send me an email, Kraig@kraigstrom.com. And I'll get back to you, and I'm happy to schedule a time that we can actually talk face-to-face nowadays. Is pretty easy, even if you're on the other side of the country. So now let's jump in. Now, last week, I continued with my bonus segment, Deal of the Week. Those of you who listen to the show long enough, you know that I love to find a really good deal. I love to find a good deal. What I want to do this week is just remind you of how I closed out last week's section. Please talk to your kids. If you've got children, if you've got nieces, nephews, cousins, young ones out there, please talk to them and encourage them to not pay retail, right? Encourage them to break away from that retail marketing machine. That's the word I guess I would use in this case. Break away from that marketing machine mentality that says you've got to pay retail, right? I told the story of a young man who came to buy something from me. I had sold it on Craigslist or something, and he had just paid $700 for a brand new snowboard, and my snowboard was available for sale for $250. And you could see how absolutely disappointed he was. But it's this mentality of just pay retail. And I'm telling you, he probably didn't pay $700 cash for it. He probably put it on a credit card, right? So please encourage your kids, young ones, family, yourself, stop paying retail. Double check, Craigslist, eBay, all these great, powerful tools that you have before you ultimately get out there and hit that buy it now button, or you go in and spend the money and whip out your credit card. Now, this week, in the first segment, Watch Your Step, I'm going to cover a piece. Gosh, man, this really just irked me, but this will be my therapy session so that I can vent about it to you. Now, last week, though, go back and listen to it. Wall Street floated this 401k bomb. Washington floated this 401k bomb that Wall Street was going to freak out about. The idea of reducing contribution limits on 401ks. Now, nobody really believed that kind of thing would actually make it through. The important thing to remember, and go back and listen to the last episode, the important thing to remember is they floated the idea. They floated the idea because you have to remember who makes the rules on 401ks and IRAs and Roth IRAs. Washington makes the rules, and Washington can change the rules to benefit Washington, right? And although it didn't have any real serious chance of happening, they actually publicly floated the idea of drastically reducing 401k limits as far as contribution limits. That's incredibly eye-opening if you pay attention to this stuff. Now, this week, I want to talk about some really bad advice from a CPA that cost me a new client, and it cost the client $130,000. Okay, so to all the CPAs who might be listening, listen, this is not a personal attack. This is just my situation. I've got to share my story because it is something that this goes back to an episode I talked about a few episodes ago about advisor bias. Everybody has biases, okay? And in this case, I had a new client prospect come visit me, husband and wife, regarding their child's college cost planning. They have a very smart child who is looking towards being accepted at a number of very high-profile universities, and they had actually come to one of my workshops where I teach and talk about college cost reduction. Now, we went through a great deal of data gathering and questions to find out what their situation looked like before I put together some suggestions that they would, if they engage with our services to help them get this done, some of the advice would include, for example, moving their rental real estate into a new legal structure. Mind you, that word is legal. An actual legal, totally good legal structure so that it would not be counted against their expected family contribution for colleges. Now, that legal structure is backed up by years of proven use, but it is not common. Most lawyers and CPAs and financial advisors and planners are not aware of that proper legal structure that can be used in this situation. Now, additional advice was included the 529 accounts. Now, they currently had 529 college savings accounts totaling over $130,000. Now, that sounds great until you take a look at what the effect is on college planning. So trying to go to a private college like Dartmouth or Princeton, what effect the 529 account could have can be dramatic. And in this case, for this couple, having put money in the 529 account will reduce their college aid, gift aid, scholarships, loans, etc., by $6,800 per year of school. Per year, okay? That's $27,000 over the course of the 4-year education. And let's face it, most kids take 5.5 years to get through school. So that could be $35,000 of college aid. And depending on the school, there are some schools that this child might get accepted to that will come up with almost entirely gift aid and scholarship aid for those who qualify financially. And in this case, the 529 account is going to reduce that potential gift aid and scholarship aid by almost $30,000. So the recommendation would have been, in that case, to analyze, based on the cost of closing the 529 account, to analyze what is better. So the cost to close the 529 account was actually only $11,000 with taxes and penalties. So $11,000 in taxes and penalties means that with the net benefit for the student, there was going to be they would be ahead by $16,200. $16,000 in potential scholarships and gift aid that they would receive net if they did not have the 529 account held in the 529 account, right? So the client calls their CPA and asks for their opinion. And the CPA, without calling me, without learning the details, without asking any questions, the CPA simply told them, that sounds like a mistake. That sounds like a mistake. That sounds, those legal maneuvers, that sounds a little too, I don't, and just basically throws all of this doubt into the mix. Basically, the CPA pulled a Dave Ramsey. The CPA, that's what I'm going to call it from now on. The CPA pulled a Dave Ramsey. Diagnosed and gave an opinion without understanding any of the details. Did not contact the financial advisor, didn't speak with a lawyer, didn't get any of the real background to understand his client's true situation, and gave out advice that says, that sounds like a mistake, right? So the client decides not to take the advice and proceeds with college applications and will lose $130,000 plus in financial aid. 130 grand in financial aid because they have their real estate wrong, their 529 wrong, they have their investment accounts titled incorrectly, they're held wrong. Just amazing that when I talked about advisor bias, I had forgot to mention CPAs. And remember, I love CPAs. I work with CPAs all the time. I really love CPAs who are not afraid to say, I do not understand that, right? But remember that some advisors, they will disapprove of something they do not understand because they don't want their client to know that they don't know. So my motto, my personal motto is this. I don't know if it's a motto, but my affirmation, if you will, to people that I work with is that I may not always be right, but I will always tell the truth. So if I don't know the answer, I'm going to tell you. I want to talk to your other advisor. I want to have a conversation with them to understand it more deeply. Okay? In this case, I know I was right. I was absolutely right. I spent a long time before I gave out any kind of advice, and it's too bad for this client. It is too bad. I am so looking forward to helping the next two couples who are coming in this week with their college cost reduction planning. I'm really looking forward to it. Now, let's move on because I'm going to get all teary and misty-eyed. Segment 2. This is questions and observations, right? So this is actually an observation that an area that I talk about things oftentimes that I just see in the world around me, business meetings that I might be at, events that I attend, podcasts that I listen to, things like that. So, for example, last week with the whole news on the 401k, I talked about, can you retire on the 401k? Go back and listen to that. Absolutely go back and listen to that talk about, can you retire on the 401k? It's going to be a huge eye-opener. Even if you did save up $1 million plus, you need to know this stuff, folks. Go back and listen to that episode. You got to have your eyes open or you're going to get truly blindsided when it's too late to make a difference. I also talked about, for business owners last week, your best investment might be right under your nose. Check that out. So this week, I want to apply Dave Ramsey's own advice. Basically, I want to go through and just prove him wrong. Okay, I want to use his own advice to prove him wrong. So this will turn out to be a two-part series using Dave Ramsey's own advice to prove him wrong. So let's do this. Last week, I listened to Dave Ramsey's podcast. And for those of you who listen to the show, you think, you listen to his podcast? Yes, actually, I do, because I want to hear what he's saying. He actually has a huge audience, a big presence on the radio and podcast world. So I want to know what he's saying so I can be prepared for it. Last week, a listener of his called in and said that his father had purchased a whole life insurance policy when he was a kid and left it to him when he was older. He said it had a $25,000 death benefit, it had cash value, and it cost, over $100 a year, $100 a year to keep the policy. And his question to Dave Ramsey was, should I keep this policy? Now, Dave Ramsey's 30-second advice, really, that's it, was immediately cancel that whole life insurance. And he said whole life insurance is a terrible investment and that the company which underwrites his policy, and it was Northwestern Mutual, was the worst company ever. Now, for the record, Northwestern is the oldest life insurance company that I know of in the United States, one of the most reputable companies, just a fantastic, old, solid company, and it is not the worst company ever. But I digress. Dave Ramsey says the company is the worst one ever. He says that you should cancel the policy and get that money into a better investment. Now, 30 seconds, right? He's told this guy to cancel that horrible, terrible whole life insurance policy, right? The key word here is investment. He said it's a terrible investment. Let me clear things up for you, okay? Whole life insurance from a mutual life insurance company. That's what Northwestern Mutual is. Now, a mutual life insurance company is one where the policyholders are the shareholders of the company. When the company is profitable, they earn a dividend. That dividend pays out in the form of cash value and dividends enhancements. It is not an investment. Here's what it actually is. It is a Class A reserve asset. According to the Federal Reserve, that's the banking system, whole life insurance is one of the safest places that banks can hold assets in reserve. Banks are not allowed to hold reserve assets in an investment. Whole life insurance does not lose value. Now, for the compliance and disclosure rules, could there be the rare odd chance of a whole life insurance policy ever losing value? Yes, it could possibly happen. The zombie apocalypse could come, and for the first time in their over 200-year history, or is it 180 years? I forget how old that particular company is, but let's just say many of these mutual companies are 100 plus years old. Could it happen that for the first time in over 100 years, these insurance companies were not profitable and they didn't pay a dividend? Yes, it could happen. But here's the thing. If a company has paid a profitable dividend for 130 plus years and they stop paying a profitable dividend, do you think that something else has happened in the world that has bigger things for us to worry about, right? I personally believe that if my whole life insurance company stops paying a dividend, I'm going to probably be hunting for food, fighting zombies, and protecting my generator in the backyard, right? I mean, that's the extreme example that goes through my head. So now, the key word that he kept saying, right, Dave Ramsey kept saying, this is a terrible investment. So what I just told you is that whole life insurance is a Class A reserve asset that banks hold on their balance sheet. It is not an investment. Bank of America holds nearly $20 billion in cash value inside these kinds of life insurance policies. Wells Fargo holds over $17 billion in reserve assets in the form of cash value. They are not investments. What this was for this caller, and man, I don't know him, but I hope that he did not cancel this policy, because it is the best guaranteed asset this guy had in his life. I cannot go back and recreate the policy, but what I did was I went back and recreated a new example just to analyze the details and give you the information, right? So whether you personally have a bias against whole life insurance or not, I hope you're willing to listen. Pay close attention. So what I did was I went back and I created a whole life insurance policy for a 5-year-old boy. $25,000 death benefit is what he said, and the annual premium was $189 per year. Now, at 5 years old, I started that and I said, what if we gave it to the son when he turned 30? What if he got married, age 30 perhaps? Hey, let's give him the whole life insurance policy at age 30. Now, the cash value at age 30 would be about $3,400. And the death benefit by then, notice this, would be $27,000. So the death benefit will have gone up a little bit because the company pays dividends and the cash value grows and interest, et cetera, et cetera. It's very slow growth, but we're not talking about that. We just want to see, what does it look like once he inherits this asset? And that's what it is. It's an asset. It is not an investment. The son, if he continued this policy, remember, he got it when he was 30 now in my example, and it had $3,400 of cash value. So the son listens to Dave Ramsey, says, hey, over and over again, Dave Ramsey says, whole life insurance is the worst investment ever. So he calls Dave Ramsey, and Dave Ramsey says, you should get rid of that horrible investment, right? Wow. Let's talk through it. The son now had paid for premium for 25 years. He's 55 years old. So remember, 25 years of premium, 55 years old now. The cash value has gone from $3,400 to nearly $14,000 in that 25-year period of time, paying the premium of $189. So what is the internal rate of return? What is the actual return over 25 years to take $3,400 up to $14,000 on this terrible, terrible investment? Well, the internal rate of return on this whole life insurance policy that I created for this example, just to analyze it, is 7%. The internal rate of return is 7%. That's on a guaranteed asset, folks, that never loses any value due to market crashes, recessions, or depressions. They just don't lose value. That's why they are Class A reserve assets. But that's not the whole story, because Dave Ramsey would still argue, 7%, that's not a very good return. Right? That's not a very good return at all. You could get 12% on average in a good investment mutual fund. That's what he says. But here's the whole story, that if you were to invest that $3,400 to start when he had inherited it at 30, you would have to also pay investment fees and taxes on any kind of gains that you would have in your, as Dave Ramsey would recommend, in your investment accounts. You would have to pay capital gains taxes, ordinary income taxes, depending on short-term, long-term. You would need to earn, listen to this, in order to match the basic guaranteed cash value of this whole life asset after 25 years, this guy would have had to make almost 10% return in an investment account every year, linear, to match the whole life insurance. That's the thing. Dave Ramsey always said it's a terrible investment, but he never finishes the story. That if you equalize the equation by comparing that investment with the fees that you have to pay, taxes that you have to pay, right? You would have to make a significantly higher rate of return to match that whole life insurance policy. So the whole life insurance policy, think about that, a guaranteed asset that has an internal rate of return of 7%. Name another guaranteed asset that this guy could have had in his life that runs 7% return. Doesn't exist, folks. It does not exist. And if you look at the death benefit, like what if this guy just wants to leave the money behind for his kids? That the death benefit by the time he gets 25 years down the road is now well over $30,000. The death benefit return, or the amount that the investment account would have to make to match the death benefit, would be nearly 17% per year to match the actual death benefit that pays out tax-free. So I get excited about this stuff, folks. This is what I'm talking about. This Wall Street mentality, it permeates everything, including the financial entertainers like Dave Ramsey, who don't ask the questions, they don't dive into the details, they don't want you to know what's behind the curtain. So here he is recommending that this guy get rid of this horrible investment. As it turns out, it's the best guaranteed asset that anybody could have ever inherited. I mean, who wouldn't want to have an account that was just growing at 7% internal rate of return with no taxes paid and has a great, death benefit for the kids, and you can use it in the future and the cash value is yours to take, right? I mean, who wouldn't want to have that? But here he is, not giving this guy any of the additional information you would need to make this kind of a decision, and telling him to cancel that terrible thing. So I really hope that guy did not cancel that policy. Oh, I hope. Now, next week, as I said, a two-part, I'm going to actually show you how Dave Ramsey's own advice proves him wrong in the world of real estate. So I believe that Dave Ramsey's advice when it comes to whole life insurance is clearly wrong, and you got my picture on that now. Next week, definitely tune in. We'll prove him wrong with his own advice in the real estate world. Now, don't forget, special offer is still out there for those of you who want to continue to try and use eMoney. eMoney is a great program for cash flow planning, estate planning, advanced planning. It has an awesome secure vault to store your documents and such. We have had a couple of glitches lately. Thank you to Equifax. There is no data breach at all to worry about, but what happened that because of the big Equifax crisis out there, a lot of the financial institutions have jumped up and changed their security protocols, which has made it more difficult to connect and get all the connections to work with eMoney. eMoney is perfectly fine. I use it all the time. It has had no issues. They are top of the line when it comes to being proactive and on top of all the current security changes. But some of the financial institutions that I connect to with the eMoney system have actually had changes in their security protocols so that they can make sure that they're catching up on things. So if you want to try eMoney, definitely send me an email, Kraig@kraigstrom.com with the subject line eMoney, and I'll set that up for you. Please take action today. Contact me. Go to LinkedIn, connect, send me an email. Let's have a personal conversation with you about your planning. We'll go over everything that you might have on your mind, and we'll dive into the details for you. I look forward to talking to you again soon. Don't miss the next episode. We'll talk to you again then.
Thank you for listening to the Personal Pension Radio Podcast. If you missed anything during the show, that's okay. We took the notes for you. Check the show notes for links, offers, and a full transcript. And don't forget to head over to personalpensionradio.com and download your free retirement income report. While you are there, we would appreciate some iTunes love. Please leave us a fantastic rating on iTunes by going to personalpensionradio.com/iTunes. Thanks again for listening.
Now for the disclosure. Information presented is for educational purposes only and is not intended for solicitation, sale or purchase of any security or financial product. Be sure to first consult with a qualified financial advisor and your tax professional before implementing any strategy discussed here. The term personal pension refers to a marketing name designed to educate future retirees and retirees about the economic principles behind creating their own pension-like income. The term personal pension is not intended to be confused with a defined benefit pension plan offered by an employer or by a government entity.